This is Brad Berry, Chief Investment Officer and Portfolio Manager with Dynamic Wealth Group. Welcome to this market and economic update. In this video, we'll discuss gold's rally to new record levels this year and what it means for long-term investors. With gold climbing above $4,300 per ounce, many are asking whether this time is different since gold has experienced prior rallies across history with mixed results. Some have called this the debasement trade, or the idea that governments might weaken their currencies through deficit spending and accommodative monetary policy. This is one reason gold has rallied this year. Over the next few minutes, we'll discuss the drivers of this and what it means for investors. Let's start with some historical context. The term debasement originally referred to governments literally reducing the amount of precious metals in coins. This allowed them to mint more coins from the same amount of metal, but of course it reduced each coin's purchasing power. Today, most currencies are referred to as fiat currencies, which means that their value comes from the trust in the governments that issue them, not from gold or silver. Modern debasement concerns center around whether governments will allow higher inflation and weaker currencies to make managing their debt burdens easier. So is this happening today? Well, the evidence is mixed. Inflation has remained stubborn, but not extreme. Most measures are around 3% or lower. The bond market is not pricing in higher inflation either. Inflation expectations from the TIPS market, which are the Treasury inflation protected securities, sit at just 2.3%. Two other factors matter here. First, central banks worldwide have been buying gold to shore up their reserves, driven by geopolitical uncertainty and the weakening dollar. Second, while the dollar has declined about 10% this year, it remains near the high end of its 20-year range. So from a long-term perspective, the dollar is still quite strong today. Now let's talk about gold's track record. History shows that predicting gold prices is extremely difficult, which, by the way, predicting stock prices is also extremely difficult. In the late 1970s, gold surged above $800 per ounce due to stagflation and concerns over the independence of the Federal Reserve. However, gold then fell and wouldn't reach this level again until 2007. After the 2008 financial crisis, gold doubled from 2009 to 2011, reaching about $1,900 per ounce. Many investors worried about runaway inflation and a dollar collapse. Neither occurred, and gold fell back toward $1,000 over the next few years, even though the Fed did not begin reducing stimulus until 2013 or raise rates until 2015. When we compare gold to the S&P 500 since 2007 market peak, gold has provided valuable diversification during certain periods. This highlights why viewing all assets from a portfolio perspective matters so much. You see, investing is not about being 100% in the best investment, as it's impossible to know what will do best going forward. Proper investing is about being prepared for a range of possible outcomes, having non-correlated investments that are driven by different variables. Gold can be just one additional asset that is managed in an overall diversified portfolio. Finally, it's worth noting that gold is not the only asset that has performed well recently. This year's rally has intertwined with strong performance across many assets, including artificial intelligence stocks, international stocks, bonds, cryptocurrencies, as well as other commodities and metals. For many investors, gold plays a role as part of a broader commodities allocation. The Bloomberg Commodity Index, for instance, includes gold alongside silver, industrial metals, energy, grains, and more. Perhaps the most important consideration is understanding what a diversified portfolio should look like. At Dynamic Wealth Group, we work with financial advisors to incorporate multidimensional asset allocation models. You see, true diversification isn't just about investing in different asset classes. Yes, that's part of it, but we go a step further and include different approaches, disciplines, and non correlated alternative strategies. As I've said many times, it's about being prepared for a range of possible outcomes, be them good, bad, or indifferent. And yes, we all hope for the best, but hope is not a strategy. Now, speaking of hope, I do hope you found these high level insights helpful. If you are a financial advisor and would like more information on our multidimensional approach towards asset management, feel free to download our white paper. You can click the link below or visit our website at dynamicwg.com or email us at info@dynamicwg.com. If you are an individual investor, we are happy to address any questions you may have and put you in touch with a qualified advisor if so desired. Until next time, take care, everyone, and make smart, logical, and fact based financial decisions.